Hello traders, you're welcome to this video and I especially welcome you back to the Forex Geek channel. Are you looking for a simple yet effective way to trade using Bollinger Bands? In this video, I'm just going to be breaking down a beginner-friendly Bollinger Bands trading strategy that will help you to identify potential trade setups with ease. So if you want to improve your technical analysis and take smarter trades, then stay tuned, okay? Let me just add the Bollinger Bands to the chart right away. Now, before we dive in, hit that like button, subscribe to the channel, and turn on notifications so that you do not miss future trading strategies. Okay, now let's just get started. Now, Bollinger Bands are a powerful indicator used to measure market volatility and identify potential price reversals. The middle band is a simple moving average, usually set at 20 periods. You can see it is set at 20 periods. Then the upper band is plotted above the SMA, which is above this middle band, right? The middle band is the SMA. The upper band is plotted above the SMA and represents resistance, expanding when volatility increases and contracting when volatility decreases. Okay. Then the lower band is plotted below the SMA and acts as a support level. The idea behind Bollinger Bands is simple. Okay, when price touches the upper band, it may indicate an overbought condition, meaning the market could pull back. Then when price touches the lower band, it could signal an oversold condition, meaning a bounce is possible. But don't just trade blindly off the bands, okay? You need confirmation signals. It is important, and that is exactly what we're going to be covering next. Now, this strategy works best in trending markets, all right? But you can actually use the strategy also in a ranging market, though. Here's how it works for a trending market, okay? First of all, you should identify the trend, all right? You should identify the trend first. Determine whether the market is in an uptrend or a downtrend or ranging. Okay, is the first thing to do. All right, if you have a trending market or a downtrend, if you have an uptrend market or a downtrend market or a ranging market, then the next thing to do is to wait for price action to touch a band. In an uptrend, you want to look for price bouncing off the lower band. You can see what happened here. Bounce off the lower band to enter a long trade. Then in a downtrend, you want to see price touching the upper band, and when you start reversing, then you can enter a short trade. Okay, and ensure that you always look for confirmation. Never enter a trade just because price touches a band. Look for confirmation signals like candlestick patterns. For example, you can look out for a doji or an engulfing or a pin bar. In this case, you can see we had a pin bar around here. In this case, you can see we had a bearish engulfing around here. Okay, so any candlestick pattern that you find for a bearish trend, look for bearish candlestick pattern. For a bullish trend, look for bullish candlestick pattern. Okay, then you can also look out for breakouts or reversal patterns. Right, then you enter your trade. Once you get your confirmation, just enter your trade in the direction of the trend. All right, then set your stop loss and take profit levels. Your stop loss should go below the previous swing low for buys or above the previous swing high for sales. A good take profit level is the middle band or strong support or resistance area. Okay, for example, let's say the market is in an uptrend and price touches the lower band. You see a bullish candlestick pattern forming like this pin bar that we have here. That's your signal to enter a buy trade. Then you set your stop loss just below the recent swing low. All right, and you aim for the middle band as your first target, or you can just aim for the upper band or a significant resistance zone that you can find as your next target. Now, there are some common mistakes that you should avoid, all right, when using the Bollinger Bands. Remember that no strategy is foolproof. Okay, there is no strategy that guarantees 100% accuracy or 100% profit making. Okay, so you need to always pay attention to risk management, pay attention to, potential pitfalls to avoid. Okay. Now, I'm going to be sharing some mistakes that you should be avoiding whenever you're using this strategy. And the first is trading without confirmation signals. Now, just because price touches a band does not mean that you should enter immediately. It is necessary to get confirmation. Just like how we had price touching this lower band and we had a pin bar giving us a confirmation. And in this case, we had price touching the upper band and a bearish engulfing giving us a confirmation. It is necessary to get confirmation. You can also use other indicators. You can use any other indicator of your choice for confirmations. In addition to your trend lines and your support and resistance zones. All these help with confirmations. Okay? So make sure to take note of that. Alright? Always look for confirmation. The next mistake to avoid is ignoring the market trend. Now, this strategy actually works best with the trend. So do not try to trade against strong momentum. You can see now here we had a buy trend. In this buy trend, you are going to notice something. You will notice that the price was mostly within the upper channel. You can see bounced off the middle, but in this case, it got towards the lower band and then bounced off. And then here again, it got below the middle band and bounced. Basically, what I'm trying to say is, it showed that there was bullish momentum since the dominant position of price was in the upper channel. In this case, you will notice that the dominant position of price was in the lower channel, showing a strong bearish trend. So it is not when you are having a strong trend in one direction, you'll be looking for buy opportunity in a sell trend or looking for sell opportunity in a buy trend. That is bad. You are going to likely lose because you have a strong momentum. So always trade in the direction of the trend. Do not ignore market trend for any reason. All right? But if you are trading in ranging markets, that is a different case. For example, when you are trading a ranging, a consolidation market, you're going to notice that the Bollinger Bands are even going to be squeezing. You can see how we're having this Bollinger squeeze. In this case, you can be trading both buys and sells, right? Because when the price gets towards the resistance, when price gets to the upper band, you just look for sell opportunities and you sell. When it gets to the lower band, you look for buy opportunity. Ensure you always get confirmation, okay? Get confirmation because breakouts could happen at any time. When it gets to the lower band, you can look for a pin bar or any bullish candlestick pattern, and you enter a buy. When you get to the sell resistance, you close your buy trade. You look for a sell opportunity, and you enter a sell. When it gets to the support, you close your sell trade. Look for a buy opportunity, and so on. But in a trading market, ensure that you trade in the direction of the trend. It is very important. Finally, do not avoid, or rather, do not keep stop losses. Do not keep stop losses. Okay. Always manage your risk. Never assume that price will automatically bounce from a band, okay? Ensure you use stop losses. And that is it, guys. A simple yet effective Bollinger Bands trading strategy for beginners. If you found this video helpful, smash that like button, subscribe for more trading tips, and turn on notifications so you never miss a new strategy. Have you used Bollinger Bands before? Drop a comment below and share your experience. I would love to hear your thoughts. In the meantime, thank you for watching, and I hope to see you in the next video. Happy trading.